everyone, and welcome to the InvestSMART Bootcamp week 4. So this is the final week of the actual teaching process, where we've got module 5 and module 6 wrapped up in this 4th week. And of course, if you're new to bootcamp, that's fine. You can always go back in the first modules preceding this, 1 to 4, and there's recorded sessions of these live webinars that are being placed online. You don't have to follow the weekly structure. We just do that just to make it a bit easier and cover off more content that way. So I'm Tom Wilson. I'm one of the product specialists at InvestSMART. And this week in particular, this module of investor psychology is something that I'm very interested in, very passionate about. My background is in commerce and also in psychology. I'm not a psychologist, I should just put that out there, but I studied psychology with the intention of being a psychologist, but I just haven't found the time yet to complete the clinical practice. So like most things, I feel like psychology is deeply woven into nearly everything we do, and investing, education is one of the best examples of it. So I find this quite interesting, and a lot of investors and traders that I've spoken through in my career, this tends to be one of the biggest problems that they encounter. It's the psychology aspect. As always, you can ask questions during this webinar. On the right-hand side, there's the Go to Webinar pop-up box there with the questions. So definitely pop in any questions or comments, and I'll try and answer them as I go. If not, I can always come back to your question even after the webinar if I don't have the information and get it to you. So first of all, just the disclaimer and the warning here. So what I talk about is general advice only. I can't give you any personal financial advice. So this webinar, just like the other ones that are being before it, it's designed to cover off any questions that you've got during the learning material that you've seen on Bootcamp. We don't give any personal financial advice. We stick to the course content, which means that this week we'll stick to modules 5 and 6. And you can definitely ask questions about the previous modules in this if you like, but I may, just to keep to the time limit and also to the relevance, I may answer those after the webinar. We also want to make sure that you're using all the resources. That's the Eureka report, that's also Intelligent Investor, and what's made up inside that, because they're very handy to supplement your learning as we go. And just remember, this is an introductory course, and we're just covering off the basics, so we won't go into very complex calculations or theories too much at all. So it's always good to cap off what we've learned so far and what we've gone through. So week 1, we've talked about the planning process. So I use an example of saving for a house deposit. So that's my goal. It takes me about 3 years, hopefully, to get that done. That's my time frame. The risk that I want to use is I don't want to go backwards. So I don't want to get something too risky. So in that 3-year period, I don't want something that means that I'll lose money, which tends to mean that I'll probably have a portfolio that's going to be a bit more weighted towards defensive assets. Diversification, so I want to make sure that I've spread my risk. I'm not going to be stuck in just one asset. I'm just not going to buy one share, or I'm not going to just buy Aussie shares. I'm going to spread my savings across a number of different asset types. And then asset allocation, what's talking about what percentage are we actually putting into those different asset types? Are we putting 30% into Aussie shares, 30% into international, and then the rest amongst fixed interest, etc.? That's going to give me an idea of what percentages. So week 2, we looked at the different types of investments or assets that we can actually invest in. And we've got shares and ETFs that trade on exchanges, both here domestically in Australia and also internationally. Then we've got managed funds and portfolios. And a lot of people still get confused about the difference between these two. A managed fund is a pool of money that investors put together, and it's managed or run by a person or a company. Basically, they're going to be advisors or stock pickers. And what you do is when you put your money into this, you'll actually buy in at a price or a unit price. So let's just say that it costs me $1.50 per unit to get into this fund. When it's trading, you'll get paid distributions. But then when it comes time to cash out, or if you wanted to, say, leave this fund and have a different investment, you've got to basically cash out usually, which means that you look at the exit price and it might be $1.51. So in that time, I've made 1 cent, and that's the price that you'll cash out or exit that managed fund. A managed portfolio, slightly different. Picture your own portfolio. So you might have some shares already. You might have a house. That's an investment. That's your portfolio. When it's managed by someone else, say, for example, like InvestSMART, what we do is we'll make sure that all the different investments are correctly balanced in terms of whatever portfolio type you've chosen. We manage that on our side. So we buy and sell different shares to keep you in that right kind of balance. And we take care of all the behind the scenes like tax reporting, for example. With a managed portfolio, just like your own portfolio, you own the underlying assets. So when it comes time to leave, if you decide that you wanted to actually transfer those assets to your own share brokerage account, it's just a matter of doing that transfer. You don't have to sell and then have a realized capital gain or realized capital loss. It's a simple matter of transferring. Cash and bonds, they're defensive type assets, and the ones that we cover off in this course, we talk about risk-free. There's a lot of information also on Eureka Report where we've written numerous articles about bonds and cash and fixed interest. I definitely recommend checking them out because they've got a lot of detail how to navigate these assets. So week 3, last week, we covered off different strategies that you might want to consider. We spoke about the difference between active and passive, active being that someone is actively managing, trying to beat the market, trying to get a return that's better than what the market can offer. Usually that means that there's more people behind the scenes involved and your costs to do that tend to be a bit higher. Passive is more of just following the market and you're happy to get the market return. So you'll never outperform the market itself. Your performance is usually market performance. So you're getting what the market's doing, less any fees. We spoke about a core and satellite approach, core being that in the middle, you've got, say, a passive type asset option, and satellite, you've got different active options. We touched on value investing, which is what the Intelligent Investor does, and they've got a lot more information on their website too. Looked at technical analysis, and then we covered off income and some strategies around that. But lastly, we looked at market timing, which based on everything that I know and what I've read and what I've heard from clients is that it's near impossible to time the market. So what do we know so far? So if we were to say, let's look back on what we've read, what we've watched during these webinars, we need to have a plan. That's the fundamental first step. So we need to also understand what can we use to complete that plan? And what kind of assets are we going to use? Are we going to use shares, ETFs? Are we going to hopefully not look at some of the more riskier assets that some people speculate about, things like Bitcoin and even sometimes gold, like gold for this week has punched through that $2,000 level, which is It's been speculated for a while that it was going to do that, but we also need to look at the risks, like we're just saying, but also the costs of trading or investing. A lot of people forget that when they buy a share, that you're paying brokerage to get into that investment, and you're also paying brokerage to get out of it as well. So over trading, when you're doing it too often, can quickly rack the costs up, the expenses, and that can eat into your return. You also need to know, or we do know, that there's different strategies to approach all of these. So week 4, it covers off the 2 last modules, which is module 5, investor psychology, and module 6, which is next steps. So investor psychology, it's complex in a sense that my experience is that a lot of investors or traders that I used to speak with, and my background was that I used to work at a broker where we would offer all these different types of markets, ranging from commodities like gold and iron to international shares like Apple and Facebook, domestic shares, and even cryptocurrencies as well. And a lot of people, they realized that the investor psychology part was a massive component of their trading or investing. But a lot of them also thought that it meant that you need to be across all the psychology. You need to also be fairly stoic in the sense that you're resilient, you don't get any setbacks, almost like a machine, and you can punch through. The reality is that even the best of investors, they still have that human element, and they still make mistakes, and they still have setbacks, and they do have repeated mistakes as well, which is what makes us human. I think the best thing is that if you do make mistakes, you're wanting to ensure that you don't make them again, and you try and put into some safeguards, usually rules like a plan or a trading plan or an investment plan, and stick to that as best as you can. So we'll look at what holds you back, what tempts you to invest, the biases, and also common mistakes. And this is covered in the content, so we won't go over the exact stuff too closely, but we'll try and add a bit more, and happy to take questions as we go. So the missed opportunities. So what is holding you back? What holds you back when you are trying to invest? And I put missed opportunities there because that's what sometimes it feels like you might be delaying an investment decision just based on the fact that you might not feel you're ready yet, or you are hesitating because you're unsure. The biggest thing about investing, and also trading for that matter, is that there's always going to be uncertainty. And we've seen that throughout history. I think there's even a quote from Warren Buffett himself in the content where he's talking about different points throughout history where we're uncertain about what will happen next. And even recently with the COVID-19 pandemic, it's definitely been the case as well. At the start of it, we've been unsure about what would happen. We've seen markets definitely come away from all-time highs and then slowly make retracements back up. And even though we've had some of these movements back up, there's still that long-term look of what will happen next. So one of the best ways to mitigate this or get around this is, and we'll probably say this a lot throughout this webinar, is to have a plan. So as long as you've sat down and you've done the planning process, so you know your long-term goals, you know how long you need to get there, you know what kind of risk you want to take, that's definitely going to put you ahead of most other investors, and also help you to strike when the opportunity is there as well. So it means that you do need to stick to your plan, but you can definitely adjust it if you need. So if you're coming into a period where there is a crisis such as the COVID-19, you may not want to fully invest. You may want to stagger or drip feed your investment cash into investments. There's a number of different ways you can go about it. there's always that human issue of we don't like losing. We don't like losing money. I mean, I definitely don't like it. It's a good method sometimes to perhaps picture what is the worst case, what's the worst that could happen, and plan for it. That's one thing that us as humans, we do very well, is that we do think about the future, and we do always try to plan around any kind of problems that might occur. There's always the black swan problem where there may be an issue that we don't even know about, we haven't even considered, and it could come up. But that's when we talk about in the previous modules about having a certain amount of cash saved up that you can rely upon if you did go through a period where it was quite difficult. On the other side of the coin is what tempts you, like what is causing you to jump in, deviate from your plan. Usually it's impatience, and that can lead to over trading. So when I would speak to a lot of traders, even in my previous job, a lot of them would get quite impulsive, and they may have a setup that they were waiting for. So as simple as, if gold reaches this price, I'm going to buy. If it drops below this price, I'm going to exit. Sometimes they would try and anticipate what it was going to do and hop in before their target, and they weren't following their own rules that they'd set. So that is a good example of us being impatient as humans. We look for opportunities where there actually aren't any, and we change our rules to fit. So it's always good to have your rules in place and stick to them as best as you can. The overtrading part is quite interesting as well. A lot of the research has shown that the people who tend to buy and sell quite frequently and do it too often, they actually underperform those who buy once, invest, and they stay in their investment for a period of time and then hop out. One thing for certain is you're definitely racking up expenses, your brokerage, doing things like that, and the broker is the one who benefits, and that's how they make a lot of their money. And we've seen even during the pandemic, a lot of people have been doing trading, such as CFD trading, which is leveraged type of trading. And unfortunately, a lot of the articles reporting that they've lost money from doing that. But at the same time, you've seen the CFD providers report record high profits for that period. So it definitely does benefit them, the overtrading. So we are wired for this inside our brains. It's linked back to the dopamine, where we are getting rewarded each time that we say buy something and it works out. There's a really interesting on YouTube, there's a young gentleman on there who talks about a dopamine detox. And I think that's just a byproduct of society nowadays, where we are constantly looking for that next dopamine hit. And we see it in the food we eat, we see it in social media, we see it in investing and trading. And he talks about how we can try and start to unwind this, and it definitely helps you to probably think straighter and also have a clearer idea. So definitely check out Dopamine Detox on YouTube. I believe the young man's name is Andrew Kirby, and I find it quite interesting. But obviously, with everything, do your own research and to see if it might help you as well. Again, we need to have a plan. So if we don't have a plan, we are probably more likely to jump in, make investment decisions or poor investment decisions. And we always need to be flexible. So we can update our plan, but just make sure you're not doing it on a whim or constantly changing just to suit the circumstances that you're in. Looking at with buyers, there's that many, and we've covered off a number of them in the content itself. Does that mean that that's all the ones that are actually out there? Well, definitely not. These are just some, not an exhaustive list. It's best to be aware of them, I find. I find that if you at least know about them, you can sort of pick yourself up on it. So you can be aware that I am making this mistake, or I am falling prey to this particular bias. And there are some solutions on there to try and get around it and what you can do. So these are the mistakes that I guess we often see with investing, even with trading. I see it myself quite a bit, not only with friends and some family, but also with previous clients at my previous job. A lot of the people who would make mistakes when it came to investing or with trading was that they just never had a plan. They would go in thinking the rosy scenario of that I can make money, it looks easy, and there's always that mantra that if you don't have a plan, you're doomed to fail. And that's definitely the case with investing as well. Record keeping is a very important part too. You need to keep track of what you're doing. If you are making mistakes, it's a good way to let it stand out so you can see what's happening. We have a tool on our website which is completely free, and it's the Portfolio Manager. And I would definitely recommend having a look at that tool or something similar. There are others that are out there as well that I think you can even pay for. And that'll help you to log all of your trades. It'll help you to log your assets and even give you an idea of if you're overweight or underweight different asset classes with a health check. I might even quickly jump on and I'll just show you where it is. So it's on the InvestSMART website. If you go to at the top, it says My Portfolio. So it might be a bit confusing because it doesn't say Portfolio Manager. And this is a test portfolio that my colleagues and I did at the start of the year. And the rules are that we start off with $25,000 and we have to choose one Australian stock for each letter of the alphabet. It was looking pretty grim, obviously, going through the COVID-19 pandemic, but it looks like it's jumped up a little bit higher for me. So this is just tracking my test assets, and you can definitely have numerous different holdings or portfolios here. So you could have a portfolio that is tracking your actual real wealth. It's tracking your super. You could put in the test ones that I've got here as well. And on the side here, it's got a health check. So I've got mostly Australian shares or equities. There are different, say, ETFs or different products I've got in there do give me a little bit of exposure to other areas, but I've chosen a particular portfolio type or risk profile that's my target. And if I was to click on health check, it'll actually give me a run through of how close I am and what I need to do to try and improve my portfolio. So I've chosen a 5 to 7 investment timeframe, which puts me in the growth category, not high growth, but growth. And here it's telling me that with the Australian equities, I'm at 56.3%. And you can see that I'm actually quite overweight, but this is just a Australian share type test. But you can always go into this and you can add assets. So if I wanted to add the family house, it won't include that in terms of that health check. But if you wanted to, you can. But I can add numerous different assets such as shares, including international shares, funds, property, cash at bank, cars I might have, liabilities such as credit card debt. And then this will track it for me as well. It also tracks dividends, which is really handy. And you can even turn on a feature called dividend reinvestment so that it if you are reinvesting your dividends, it'll do it for you. If you are in any of the portfolios that InvestSMART or Intelligent Investor offers, you'll also see your portfolio within this portfolio manager too, which is quite handy. So remember, you can always ask questions as we go along. If you find something that doesn't make sense, or if you had some questions about the content that you wanted to clarify, this is probably the best opportunity, and I can try and do it on the spot. Or if any comments you've got as well, definitely pop them in there too, and I'll take them into account. So the other thing is, we see a lot of investors just in society, I guess, not diversifying, which means that there's always been this idea, at least in Australia, that if you're buying some big names on the stock market, such as Telstra or Commonwealth Bank, that was enough. And I know my grandfather, and using him as an example, he often used to just buy those big names. So when there was a bit of a hit to the Australian economy, his whole portfolio would drop. And that's because he didn't have anything outside of it. He didn't have any international shares, which nowadays is quite easy to do. You can do them through things such as ETFs, exchange traded funds, and that will get you exposure to the international equities. You can even invest in managed portfolios like the ones that InvestSMART has. And we call them, I'll just show you where they are, because this is something that a lot of people, I don't think they know that they can do this. You go to the Invest with Us section, you've got the off-the-shelf diversified portfolios here on the left. So that I was talking about before, about growth, high growth, etc. They're diversified automatically. So they've got a number of different assets in there. Single asset class. So if I was my grandfather and I had heaps of Aussie shares, I could go in here and just buy a portfolio of international equities. And what that would do is it would supplement my portfolio and give me exposure to international shares or international markets. And it's not just US, it's actually a number of different countries as well. And you can even see what you're invested in. There's some Asian shares, the S&P 500, and so forth here. So that's always good to know. And that health check on the portfolio manager that we looked at before, it will give you an idea of where you might be lacking in diversification. So that's definitely a big problem in Australia still. And part of the financial literacy that I'm quite passionate about is letting people understand that they should diversify, and that sometimes when they think they are diversified across different sectors, just in Australia, that's usually not enough. The other big thing that we see is a lot of investors or traders, they tend to panic at the first sight of a downturn, perhaps. And we saw that quite a bit at the start of the pandemic that we're going through at the moment. If you've got a long-term time frame of 5 to 7 years or 7 years plus, your portfolio you've chosen will reflect that. And that usually means you're in growth assets like international shares, and domestic shares, so Aussie shares and international shares. These, just by the pure nature of how they work, they need a longer time frame to wear out any ups or downs. So if you've invested and you do have a bad year, the balance of probabilities is that it will balance out. In fact, it will be a blip on the radar, as we've seen in the past. And we can't always use the past as an indication of the future. But if you're properly diversified and you're properly weighted in terms of what kind of approach you're taking, and it matches your time frame, there's usually no need to panic, because in the long-term scheme, it will balance out and grow because of those reasons. So we did see a number of investors who, across numerous different countries and different investments they were invested in, when we had this downturn at the start of this pandemic, they hopped out of their investments, they liquidated. And it's a case of market timing where they said, I've had a bit of a loss, I'm going to hop out. I'm going to crystallize that loss. So I'm going to take that loss on the chin. I've lost money. And I'm going to wait. I'm going to wait until the market picks up. The biggest problem with that is, how can you tell? If you could time the market, that would be fantastic. I would probably invest with you myself, because you're someone who can see what's going to happen. The reality is that it's virtually impossible. And there's so many different pundits out there who have their view on what might happen, and they might be right a certain percentage of the time, but the problem is that you can't tell. So the people have taken their money out. Some of them have started to put it back in, but they're putting it back in at levels that are higher than where they got out. So they've crystallized that loss in between. So that's actually put them a couple of steps backwards. And the last mistake there, and there's other mistakes as well, but it's coming down to, I guess it can cause you to panic when you are coming into something like a crisis like this COVID-19. You've chosen the wrong risk type. So you've either gone in too aggressive with a short time frame. So for example, I used the example of me saving up for a house deposit. I said 3 years, that's how long I want. I shouldn't and I wouldn't go into an investment that says it needs a time frame of 5 to 7 years, because the risk is that although I might get some growth early on, there's the likelihood that 1 year might have negative growth, and that might put me backwards again, which is, I don't want that. So I, in my case, would choose something aligned to my 3-year time frame, something that's a bit more weighted inside the things like defensive assets, like fixed interest or bonds, with a little bit of growth assets. On the flip side of this, you've got some investors who unfortunately don't like risk whatsoever, and that's okay. I know a lot of people, it's based on if you can sleep at night with what you're invested in, but they'll choose a conservative option when they've got a long-term time frame. So they might be trying to save up for future wealth, and they've got a time frame of 10 plus years, and they'll choose conservative, something that is much, I guess, safer and defensive, but the growth on that is that low that you're missing out on numerous opportunities to actually grow your wealth. So we've covered off the investor psychology part, and obviously there's a lot of different areas in there that we've looked at, and the content does talk about ways to try and mitigate or reduce those kind of problems as humans that we come across. It basically comes down again to having a plan, diversifying, knowing your time frame, knowing your risk, and then investing in investments that actually match that profile. So the next steps, which is quite interesting because we've got this far, and now a lot of boot campers are saying, well, I know the basics. I know what I can invest in. I know what kind of plan I've got, but what do I actually do with it? So we've got our plan. If you don't have a plan, it's highly recommended you go back and do one. And that's, again, like I was just saying, go through your different goals, your timeframes, your risk. If you've already got a plan and you're invested in different assets or different investments, maybe it's time to have a review and just see whether or not all of your investments align with your timeframes, your risk. You could use the portfolio manager there as well. It's a quick and easy way to do it. You can just put in all your different assets and use that health check feature, and it'll give you an idea based on what risk profile that you've got. You can also have different types of portfolios. So if you have short-term goals, perhaps create one portfolio for that. If you've got long-term goals, create a second portfolio. So one thing that InvestSMART does as well, we have a number of different investments that, or even services that can help. Now, it's important to know that there are others out there. I'm just talking about ours because I'm very familiar with how they work. But there are different tools that we've shown you on previous webinars as well, where you can search for different assets, such as different managed funds, different shares. So it's definitely good to have an idea of that. But it just boils down to, again, of knowing what's out there, knowing the risks and also the costs of getting involved. So we tried to bring it down to 3 different approaches that someone might have. And there's the first approach of that you want it done for you. So you're not someone who's got the time to sit there and look at what to invest in. You just want it invested. You know your time frame, your risk, your goal, and you just want to get it done. So InvestSMART has their managed portfolios, and we saw 4 of them before. And I'll quickly just show you again. The thing is, you can go to Invest with Us. The diversified portfolios are off the shelf. You can have a mix of different types. So say, for example, if I use my situation, I've got the goal of saving for a house deposit, and that's going to be 3 years. So I can say, okay, the conservative is a 2+ year time frame. Then if I said I've also got a long-term wealth goal, which, because I'm in my 30s, I've got more than 20 or 30 years to grow this, I could look at something with a longer time frame, like high growth. So for example, I could open up an investment portfolio and have, say, $80,000 in conservative, and then have another $80,000 in high growth. It'll actually split amongst the 2. The biggest thing that InvestSMART does, and it's, I think, an industry first, is that we cap our fees. So instead of your fees growing as your investment amount grows, as soon as you get to $82,000 in investments, you are capped out at $451 per year. So that's $451 you pay. So if you've got more than 82,000, if you've got 180,000, you pay $451. If you've got $1 million, you pay $451. They also start off as low as $99. And then in between, in the middle, from 18,000 to 82,000, it's 0.55%. The intelligent investor also has their portfolios. So the investment ones I was showing you, they're passive. They're looking to track the market and get the market return. In previous webinars, we've spoken about how the intelligent investor ones, they're actually active. So you've got Nathan Bell and his team who sit behind these, and what they're doing is they're looking for different opportunities to get in and get out of different shares. And you've got all the information in here as well. And there's different ones at the top. And you can even see, because you've got an intelligent investor membership as part of Bootcamp, you can actually see what they've got inside here. So I can click on the growth portfolio and actually see what the latest holdings are, which I myself just find is interesting. We do have a lot of clients who actually have their own brokerage account, and they just follow this and buy and sell, a very manual process, but it is an option as well. If you don't want to do that manual process, you can have the team do it for you by investing or considering their managed portfolio. So a mix of both. Well, that's if you wanted to, say, use a passive type portfolio or investment like the InvestSMART ones, and then maybe an active type such as the intelligent investor that I just showed. So that's a mixture of the 2. You could do things such as have as a core and satellite approach, which we spoke about last week, have a passive type investment such as the InvestSMART portfolios at the core. And then on the periphery, on the satellite, you've got actively managed investments. You could have the stock picking ones that you choose yourself. So you can manually have your own investments and trade and invest in shares. You could have, say, housing or other kind of property investments. It depends on what kind of mix you'd like. This is where the Eureka Report part comes into it. A lot of the clients that we've got say they find chatting to the CEOs quite handy, and this is what Alan Kohler does day in, day out, speaks to the CEOs, any kind of entrepreneurs, people who start companies, and gets to the core of what they're actually doing. And this is quite handy. They've also got heaps of advice here, such as their little superannuation section talking about taxation and retirement compliance. And they talk about, you can see all of Alan's charts that he puts on the ABC each night. He actually uploads them here as well. There's numerous other experts on here. Elizabeth Moran, she's written extensively about bonds. So if you've got questions about bonds or even share funds, high yield shares, and understanding all that, there's just so much information. So I definitely recommend, while you've got the access, jump in and have a look. And just saying that as well, you've got the recommendations too from intelligent investors. So you can see if you wanted to manually have a component of your portfolio that you're doing yourself, you can see all their recommendations. So lastly, you might have time on your hands and you might have enough experience as well where you can manage it yourself. So you don't need any kind of portfolios done for you or managed. If you're going to go down this path, definitely look at those recommendations that I was just showing you. It might give you an idea of what you may want to invest in. It does the research for you. And then also we spoke about Eureka Report as well. So if you're wanting to get the latest from the actual CEOs themselves, that's a very good resource to use. But it boils down to, and I'll say it again, having that plan. If you've got the plan, at least you know where you're going. Remembering to diversify, not being stuck in one company or one asset or one market or one sector. Keep your fees down, and that comes down to not only the fees to have someone manage something for you, but also the costs and expenses involved, such as brokerage, any kind of hidden fees that some fund managers might have, such as outperformance or trying to outperform a market. Always check and see, what are you trying to outperform? What are you measuring yourself against? Some won't use an industry benchmark. They'll actually choose something that's very easy to beat, such as the overnight rate, the interest rate, or the RBA rate. And that's so low at the moment that nearly anyone can outperform something like that. The fees that you pay, remember this, that will slow down your growth, growing your wealth. It's better to keep that money in your pocket or in your portfolio and have that full effect of compound growth. So the more that you keep in there, the faster that it'll grow with that benefit of compounding. Lastly, don't be afraid to get help if you need it. Financial advisors are helpful. We've sort of never said during this that, don't go and waste money seeing one. Sometimes you need that third party to give you the right guidance on what to invest in or help you set your goals. If you go down that path, you can seek out, and Google's a good friend of mine, and I'm sure it is yours, to actually search for fixed fee financial advisors. You want to avoid going to a financial advisor that has a percentage-based fee. And that's just because when you deposit or invest through them, they'll just have a percentage that they'll take. And that's ongoing sometimes, and it's also very open-ended. You can search for financial advisors that you just pay a one-off fee and you get a statement of advice. And it also removes that conflict of interest where they're not telling you to invest into certain things because they'll benefit. They're just giving you a statement of advice that says, this is what you fall into in terms of risk profile. Here's a plan to try and go about it. So we've come to the questions part. Definitely, if you've got questions about this module, number 5 and number 6, definitely go ahead and ask. And I've just got a question come in here as well. I'll just pull it up and have a look. So Max is just asking me, are there any share brokers in Australia that are recommended? There's actually quite a lot. There's a number to choose from. Throughout this webinar and even the content, I refer to some of the bigger brands such as CommSec or even NabTrade. They are obviously much bigger. They tend to charge a higher brokerage for their Australian shares, but sometimes it's just because they're very easy to use. They've got the good support behind it as well. It's no means a recommendation, but some of the bigger brands are quite helpful, and you can get those brokerage fees down if you do happen to have an account with them. There's other smaller players. There's companies like IG who are well known for their CFD trading, which is the riskier leverage trading, but they've also got on the side their share trading. The biggest thing with them is that you don't get a HIN number, a holder identification number. They use a different kind of model when it comes to share trading. So you buy the share, you actually have ownership of it, but it puts it into a pool where it's actually held by a custodian. So it's slightly different, and that's how they get around cheap brokerage as well. It's actually like an international standard type of model, but in Australia, most investors are used to a HIN and being able to transfer the shares or see them through a registry, turning on dividend reinvestment, things like that. But definitely do some research. I'm pretty sure that CanStar has a method to compare all the different brokers and what they offer, and have a look at their websites, see what their brokerage is, look out for any fine print. Some of them, I think IG charges like a subscription fee. If you're someone who doesn't trade much, they probably don't want you as a customer because you're not turning over as many trades. So just keep an eye out for things like that. So I don't have any other questions here. So what I might do is wrap up this webinar, and this webinar will be available online through the bootcamp content, and it'll be replaced eventually with a newer live version. So we'll be reverting back to week 1 next week. So you can definitely tune in then as well if you wanted any week 1 questions covered, if you don't have any of the content covered in the recorded video. For those of you who have followed the week by week plan, this is the final week. Module 5 and 6 are the last 2. So congratulations and well done on getting through a course like this. It's a big step to undertake something where you may not be familiar about the basics of investing, but if you've followed all the content, you've done the quizzes, you've probably got a better idea than most Australians nowadays. So that's something to be proud of, and I definitely wish you the best. You do have access to all the content for a period of 90 days. You can copy and paste, and you can download it or print as a PDF as well. And we're looking at trying to get a more polished PDF version available. But you're always welcome to reach out at InvestSMART and ask us any questions. You can do that either on the website. There's the little intercom button on the bottom right, and that's staffed by real humans during 9 a.m., 5 p.m. Sydney, Melbourne time. You can also email, and we've got a new email, which is bootcamp@investsmart.com.au, or you can also use the old one, invest@investsmart.com.au. And lastly, you can phone us as well. But until then, thank you so much. If you've got any comments, please definitely leave some for us. But have a lovely weekend.